Enron. How the biggest accounting scam in history, Unraveled Enron, was named America's most innovative company 6 years in a row. 1 month after winning that award for the 6th time, it declared bankruptcy. It was completely fake. All of it. At its peak, Enron was worth more than $70 billion. Wall Street loved it. Journalists praised it. Analysts recommended it. Employees invested their entire life savings into it. And almost nobody realized the company was hiding one of the largest frauds in American history. Today we are breaking this story down into 5 parts. Part 1. How Enron became Wall Street's favorite company. Part 2. The accounting trick that made fake profits look completely real. Part 3. The people who started asking very dangerous questions. Part 4. The collapse that shocked the entire world. And Part 5. The lessons that changed corporate America forever. Let's get into it. Part 1. The perfect company. To understand how one of the biggest frauds in history was pulled off, you first need to understand why absolutely everyone loved Enron. Because this was not some obscure company operating in the shadows. Enron was celebrated, admired, held up as a model for how modern American business should be run. It started as something completely boring. Enron was founded in 1985 in Houston, Texas as an energy pipeline company, moving natural gas from one place to another. Nothing glamorous, nothing exciting, just pipelines and energy contracts. But then came Jeffrey Skilling. Skilling was a Harvard Business School graduate and a McKinsey consultant who joined Enron in 1990 with a vision that went far beyond pipelines. He didn't want Enron to just move energy. He wanted Enron to trade it, to create markets around it, to turn a boring utility company into what he called the Amazon of energy. And for a while, it looked like he was doing exactly that. Under Skilling's leadership, Enron expanded aggressively. They moved into electricity trading, broadband, weather derivatives, financial products that most people had never even heard of. The stock price exploded. Executives became celebrities. Fortune magazine named Enron America's most innovative company not once, but 6 years in a row. Wall Street analysts were falling over themselves to recommend the stock. Journalists wrote glowing profiles. Investors poured billions in. You might be wondering, with all of these smart people watching Enron so closely, how did nobody see what was actually happening? Here is the uncomfortable answer. Nobody wanted to look too closely, because when a stock keeps going up and everyone around you is making money, asking difficult questions feels like a very bad career move. But there was one question that should have stopped everyone cold. Nobody could clearly explain exactly how Enron was making so much money, and that should have been the first warning sign. Part 2. The accounting magic trick. Here is where we need to slow down and explain something carefully, because this is the engine that powered the entire fraud. It is called mark-to-market accounting. And while the name sounds complicated, the concept is actually very simple once you see it clearly. Here is how normal accounting works. You sign a contract today. You earn money from that contract over the next 10 years. You record the profits as you actually earn them. Simple and straightforward. Now here is what Enron was doing. Imagine you sign a 20-year energy contract today. You estimate that contract will generate $100 million over those 20 years. Normal accounting says you record those profits as they come in, year by year over 2 decades. Enron booked all $100 million immediately. Today, on day 1, before earning a single dollar. Now you might be wondering, is that even legal? The answer is yes. Mark-to-market accounting is a legitimate practice, but it requires extremely accurate and honest estimates of future profits. And Enron's estimates were anything but honest. Project after project was booked at wildly optimistic profit projections that never came close to reality. Contracts that were losing money were still showing up on the books as profitable. Revenue that had not been earned and would never be earned was being reported as real income. Quarter after quarter, the numbers looked spectacular. More profits, more growth. Higher stock price. Wall Street cheered. Executives collected massive bonuses, and the cycle continued. But here is the problem with building a company on imaginary profits. Eventually, the gap between what you are reporting and what you are actually earning becomes impossible to hide. So Enron invented an even bigger trick. And this one didn't just create fake profits. It hid billions of dollars in real debt. Part 3. Hiding the debt. The man behind this part of the story was Andrew Fastow, Enron's chief financial officer. Fastow was considered a financial genius inside Enron, and in a deeply troubling way he was, because what he constructed was one of the most elaborate financial deception schemes ever attempted. Here is the simplest way to understand what Fastow did. Imagine you have an enormous amount of credit card debt that you don't want anyone to know about. So instead of carrying that debt in your own name, you transfer it to a separate account held by a friend. Now, when someone looks at your finances, they see no debt. They see a clean balance sheet. They think you are doing great financially. That is essentially what Enron did. But instead of a friend's account, Fastow created hundreds of separate legal entities, called special purpose entities, that existed specifically to hold Enron's debt off its official books. These entities had names like LJM Cayman and Raptor. They looked like independent companies on paper. But in reality, they were controlled by Enron and existed for one purpose only, to make Enron's financial statements look healthier than they actually were. The result was staggering. Billions of dollars in debt that should have appeared on Enron's balance sheet simply disappeared from view. Investors could not see the real financial condition of the company. Analysts were working from numbers that had been deliberately engineered to mislead them, and the stock kept climbing. You might be wondering, where were the auditors? Where were the people whose entire job was to catch exactly this kind of thing? That is one of the darkest parts of this story, and we will get to it very shortly. Because before the walls came down, a small number of people inside and outside Enron had started asking exactly the right questions, and the answers they were finding were about to change everything. Part 4. The Whistleblower and the Collapse. Her name was Sharon Watkins, and she was an Enron vice president who in August 2001 did something that took enormous courage. She wrote a memo directly to Enron's CEO, Kenneth Lay, warning him that the company's accounting practices were deeply problematic and that Enron could implode in a wave of accounting scandals. She wasn't the only one asking questions. Outside the company, a small number of financial analysts and investigative journalists had begun noticing that despite all the celebrated growth, Enron's actual cash flow never seemed to match the profits being reported. The numbers didn't add up no matter how you looked at them. In October 2001, Enron announced a massive write-down of over $1 billion, essentially admitting that large portions of its reported value had never been real. The Securities and Exchange Commission launched a formal investigation, and then the news that investors had feared most began to emerge. The debt that had been hidden in Fastow's special purpose entities was now coming back onto Enron's books. Billions of dollars that investors never knew existed suddenly had to be accounted for. The reaction was immediate and devastating. Enron's stock price, which had traded at over $90 per share just 12 months earlier, began collapsing. $90, 70, 40, 20, 5. By the end, it was trading at less than $1. Tens of thousands of Enron employees who had invested their retirement savings in company stock watched those savings evaporate in real time. People who had worked their entire careers at Enron lost everything in a matter of weeks. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. In less than 12 months, the company that Fortune magazine had called America's most innovative had ceased to exist entirely. Part 5. The Aftermath and the Lesson. The criminal cases that followed were swift and significant. Jeffrey Skilling was convicted of federal felony charges, including conspiracy and securities fraud, and sentenced to over 20 years in prison. Kenneth Lay, Enron's founder and CEO, was convicted on multiple counts of fraud and conspiracy, but died of a heart attack before he could be sentenced. Andrew Fastow pleaded guilty to conspiracy charges and served 6 years in federal prison. But the consequences went far beyond the individuals involved. Arthur Andersen, one of the most prestigious and respected accounting firms in the world, was indicted for obstruction of justice related to its auditing of Enron. The firm that was supposed to catch the fraud had instead helped conceal it. Arthur Andersen collapsed almost immediately after the indictment. An 89-year-old firm with tens of thousands of employees around the world was destroyed. The scandal forced the United States Congress to act. The Sarbanes-Oxley Act was passed in 2002, fundamentally changing how public companies report their finances, how auditors operate, and how corporate executives are held accountable. It was the most significant reform of American corporate law in decades. But perhaps the most important lesson from Enron has nothing to do with accounting rules or legal reforms. Here is the truth about what really happened. Almost everyone involved in the Enron story, the analysts, the journalists, the bankers, the investors, had a reason to believe the story. When a stock keeps going up, everybody gets rich. The analyst who recommends it gets paid. The investment bank that underwrites its deals gets paid. The executive whose bonus is tied to the stock price gets paid. In that environment, asking uncomfortable questions doesn't just feel awkward. It feels financially dangerous. Nobody wanted to be the person who killed the golden goose. And that collective willingness to look away, not out of stupidity but out of self-interest, is what allowed one of the greatest frauds in history to grow so large before anyone stopped it. The most frightening part of the Enron story isn't that executives lied. It's how many smart people believed them. Wall Street's best analysts believed them. Major banks believed them. Respected journalists believed them. Thousands of employees believed them. Because the fraud wasn't built on one single dramatic lie. It was built on thousands of small lies stacked carefully on top of each other until they looked exactly like success. And when reality finally caught up, $70 billion disappeared almost overnight. The next time everyone around you agrees that something is too good to question, that is precisely the moment to start asking questions. If you enjoyed this breakdown, subscribe to Brand Autopsy. Every week we uncover the real stories behind the biggest business successes, failures, scandals, and collapses in history. And trust me, the next one is even crazier.